The INR, Indian Rupee, falling against the USD is not caused by one single reason. It's a mix of global money flows, oil prices, trade balance, inflation, and also investor behavior. Right now, the pressure or INR is stronger because of both global and India-specific factors. So let's talk about India imports more than it exports, which we call trade deficit. India buys a huge amount of goods from abroad, especially crude oil, electronics, gold, machinery, ships, and technology services. Most of this are paid for in US dollars. So think of it like this. India needs dollars to buy imports. More demand for dollars, USD, becomes expensive. INR weakness relative to USD. So since India imports a large share of its crude oil, any rise in oil prices increases dollar demand sharply. Crude oil prices are a major reason. This is one of the biggest reasons. India imports most of its oil. When crude oil prices rise, India spends more dollars on imports oil. Companies buy more USD. More USD demand pushes INR lower. So recent geopolitical tensions and higher crude prices have increased pressure on the rupee. Reuters report oil-related pressure as a key factor behind recent INR weakness. Now let's talk about the strong US dollar and high US interest rates. The USD becomes stronger when the US economy or interest rates are attractive. I'll give you an example. If the US offers high bond yields, global investors move money into dollar assets because returns look safer or better. The result, investors buy USD. Emerging market currencies like INR weaken. So higher US Treasury yields and safe haven demand for dollars have recently strengthened the USD globally. Foreign investors pulling money out of India. Foreign investors, FLLS or FPLS, invest in Indian stocks and bonds. When they exit, they sell Indian assets, convert rupees into dollars, and take money back abroad. That increases dollar demand and weakens INR. So recent reports point to sizable foreign outflows from Indian market as a contributor to rupee weakness. Inflation difference between India and the US. Currencies tend to weaken over time if inflation is higher. If India's inflation is structurally higher than the US, purchasing power of INR falls faster. Rupee gradually depreciates over long periods. So this is why INR weakening over decades is partly structural, not just a crisis signal. RBI doesn't try to make INR strong, it tries to keep it stable. A common misunderstanding. The Reserve Bank of India usually manages volatility, not a fixed exchange rate. So RBI often sells dollars from forex reserves to slow sudden falls, but generally allows gradual depreciation rather than defending a specific number forever. Now, global fear money goes to USD. Whenever there is a war, geopolitical uncertainty, recession fear, stock market panic, investors move toward US dollar because it is treated as the world's safe currency. That automatically pressures emerging market currencies, including INR. So, I'll give you a simple explanation in one sentence. India needs lots of dollars. Oil imports, investors move money to the US, and the dollar becomes stronger globally. So, INR weakens.